Hello and welcome back to another Monday market update about the Phoenix real estate market. I'm Caitlin McKegg. I am a real estate broker here in Phoenix, Arizona, and every Monday I am here giving you an update on what's going on in the market. And it's been pretty exciting lately because things are changing. For a long time, all I've been able to say is that we've been in a strong seller's market and all of the stats that surround that, but finally there are some new things to report and I have a lot of great info for you guys today. So if it's your first time to my channel, make sure you subscribe, hit the bell for notifications. You don't want to miss these updates every Monday. And I also post other videos throughout the week about living in Phoenix or Phoenix real estate, so you don't want to miss those. And finally, right before I start, I just want to say thank you to the Cromford Report. That's where I get a lot of my information from. I am a subscriber to the Cromford Report, which provides excellent tools for realtors, charts, graphs, a lot of wonderful data from the MLS for us to share with our clients. So I come here and share a lot of that with you guys every week. So let's start talking about a few different things. I've got my whiteboard here today, a few screenshots to share with you, and let's get into it. So foreclosure and forbearance. Are you hearing a lot about foreclosures? It seems like that's a really big clickbait headline these days. People want to talk about a foreclosure crisis coming because of all the forbearance, and it becomes synonymous with the word crash, I feel like sometimes. And so I'm here to tell you, let's look at the numbers here. So this is from Keeping Current Matters, and they got this information from the Mortgage Bankers Association. And they have here loans upon exiting the forbearance program. 37% were paid in full. 46 or 44% were workouts or repayment, and 18.4% were still in trouble. So out of all of the loans that went into forbearance, there was only 18% throughout the country that were still having problems making their payments. That's a really small amount when you think about the number of households that is as compared to the amount of households we have throughout the US. That is such a small amount of homeowners that are still having issues. And the thing of it is, most homeowners have so much equity in their home right now, even if they bought 6 months ago, that if they're still in trouble with their payments, more than likely they can sell their house and get out of it rather than actually going to a foreclosure. So let's look at the foreclosure numbers. Again, this is a national scale. This information is from Keeping Current Matters. Foreclosures in the last 2 years, we've had about 413,000 fewer in the last 2 years than we did before. A lot of that is because we did have that forbearance program, so that was really helping people get right with their payments or stop their payments for a little bit to catch up because of the pandemic. But you can see these last 2 years foreclosure numbers have been really low, and when you consider that there's only 18% of people that are having trouble getting out of forbearance, I don't know that that amount of foreclosures is going to affect anything. And here's why. Across the country, we have about 2 months of inventory. And in a balanced market, you have about 6 months of inventory. So even if, let's say, all 18% of those homeowners end up going into foreclosure, that's not going to be enough supply to flood the market, to change the landscape like we saw back in 2008. So sure, there might be some more foreclosures. We'll see what happens. But again, remember the point that most people have equity, whether they tried to or not, in their home just because of appreciation rates throughout the country. So more than likely, they can just sell and get their equity back. And hopefully they know that. Hopefully they're being advised correctly and not thinking that foreclosure is the only option. So that's what I wanted to talk about on a national scale. Let's talk about a few things that we need to watch out for. Okay, so according to the Cromford Report, there are 3 things that will happen before prices start to go down. And it's really interesting to start talking about the changing market because people start to say, oh my gosh, prices are gonna go down. I can't wait, I'm seeing it already. It's gonna be a buyer's market. And it's like, whoa. don't get ahead of yourself here. So there's 3 things that we need to look out for that will make a change before we even see prices affected. The pricing is the lagging indicator of any market change. So the first one, and I talked about this, I think it was last week, is the number of price changes per week. In other words, the listing price cuts. So people have listed their homes for sale. They listed it at $500,000 thinking that they were gonna get $500,000 for their awesome home. Come to find out, no one's biting, so they have to decrease the price. So listing price cuts, those don't really exist when you're in a super strong seller's market. It's very rare that people have to cut their price unless they just started way, way, way too high. And you can see here that we've got this going upward. So listing price changes have totally started to increase. We've already seen that movement, and I mentioned that a while ago. I think January is somewhere around there. It's kind of hard to see on this graph, but when I ran the numbers, it's about a 40% increase in listing price cuts in the Phoenix area since January. So that has happened. Okay, we can check that box. Number 2 thing that happens is our days on market starts to go up. And you can see right here, have not seen that yet. We're sitting around 7-8 days. Yes, we went up to 8 days from 7 this last week, but 1 week does not make a trend. So we need to keep an eye on that. But it's been hovering, around 7-8 days this whole year. All of this is holidays, which that always spikes up during the holiday time. So we need to watch the days on market. If consistently over the next 3 to 5 weeks, we see that creeping up, then we can check that box that the second thing has happened. Let's move on to the third. So the percent of closings with seller paid closing costs. So the third thing that happens is the cost of the sale becomes more expensive for the sellers. In a strong seller's market, sellers don't have to do anything, right? We don't want to do any repairs. We're not going to pay for your closing costs. We're not even going to change our price if you have a low appraisal. And so things start to change as the market changes, where sellers actually may need to give some sort of concessions, whether that's for inspection reasons or whether that's for actually paying for the seller closing costs or something like that, or buyer closing costs, I'm sorry. So you start to see that more as the market softens. And you can see these numbers are hard to see, but where we're at right now is about 3% of sales currently are getting seller paid closing costs, or like sellers assisting in the closing costs for the buyers. Only 3%, and that's been low for a while. If we look back here, this is April of 2020, right around here, February of 2020. Now, keep in mind that was the start of the pandemic, but also even before the pandemic, we weren't in such a strong seller's market that we're in today. So that was about 25% seller paid closing costs back then. So we've got a long way to go to start to see a change towards a normal market. This indicator has not moved yet, but it's something to watch. So if sellers cut their prices, they're on the market a little bit longer, and then they decide, okay, I will give you a concession for repairs, or I will help you with your closing costs, and this starts to go up, then we can start talking about seeing prices come down. Another thing that we need to keep in mind is prices are only going to come down if we have more inventory on the market than we have buyers. And at this point, we're still at a very big deficit, although listings have been going up. So let's move into talking about that. This is the contract ratio. This is something that the Cromford report has come up with and is proprietary to them, I believe. And they define this by the number of listings under contract divided by the active listings times 100. So the ratio, the contract ratio right now, we're over here, this yellow line here. I should probably take that off. This yellow line, that's 2022. We're just under 150. But what's interesting to see is how quickly that has gone down. And when you look at all these previous years, 2021 is the blue line, 2020 is the dark, all these colors are so similar. This one here, I mean, none of these years do we see any like downward trend like this. kind of crazy, clearly going in a direction that's very strong. But here's your key of what's going on with these contract ratios. So anything over 100 is considered a frenzy market, according to the Cromford report. 75 to 99 is a hotter market, 41 to 74 warmer. It goes down from there. So at 150, we're still in a frenzy market, technically. But clearly, where we're headed right now, I don't know how much longer that frenzy is going to last, because we're going pretty quick out of that frenzy market. So I think this is interesting to look at. I know you guys come here to see the Cromford Market Index every week, and I'll get into that in a second. But the contract ratio is a little bit easier to understand because it's talking about what our supply looks like on the market and what the demand is for that, obviously, because if there is high demand, then we're going to have a lot more under contract than are actually on the market. So this is another indicator to watch. It's clearly started to move pretty seriously. So let's keep an eye on that in addition to those other three and the market index. So talking about the market index, if you're not new here, you can skip this part. If you are new, the Cromford Market Index is their proprietary algorithm that helps us understand supply and demand in the market. And any number on this index that's above 110 means we're in a seller's market and prices are expected to continue to increase. If it is under 90, we are in a buyer's market, and you can likely see home values decrease because we have more supply than we have demand. And so our number this week is 342, and clearly still in a seller's market. We're well above 110, but this number has been going down, and it's been going down quickly. So demand, this is like a red letter day, you guys. Our demand is finally under 100 for the first time in a while. Actually, I should look back and find out when the last time demand was under 100. I haven't seen it since I've been doing these market updates, I don't think. So demand is falling quite a bit. A lot of that being due to interest rates, which I talked about last week. And then our supply over here, this is going up, you guys. 29, we're almost at 30. So what this means is 29 is basically 71% below normal, assuming that 100 is normal. And then for demand, we're like 1% below normal on demand, which I used to say that we were 25% above normal for demand, and now we're actually below. Now, technically, the Cromford report says that any number between 90 to 110 is considered normal. So I guess you could say our demand is now in that normal range. But if we're going to use 100 as kind of that marker, we're getting on the lower side of normal for demand. Supply's been going up quite a lot. It's been a while since I've been able to say 70% below, and we'll see how much that continues to climb, because it wasn't that long ago that this number was still like 23 to 24, I think, somewhere in there. And so let's look at the cities. So that's this little chart down here. Every city has its own CMI according to the Cromford report. So they take all this same information and then they do it per city. And so you can see your city on here. This is where it's currently at in this column here. This is where it was at last month, and the percent changes are there. Now, every one of these cities has a red arrow, meaning that it went down over the last month. I think the last 2 or 3 weeks when I've shown this chart, every city has been red. But before we had at least like 1 or 2 green arrows going up. But right now, every city is deteriorating for sellers. That's how they describe that. Okay. So it's interesting to see this. You can look at what your city is doing. The change overall with these cities has been a 20% decrease over the last month on average. And last week, when we looked month to month, it was 18% decrease. So that's clearly changing. We're starting to accelerate even more. I want to say the week before that, I can't remember exactly, but every week it's gotten bigger and bigger in terms of the percentage that we're changing, going downward for each city. So that's all I've got for the CMI. I wanted to read something directly to you guys from the Cromford report. And this is related to this contract ratio that we were talking about. So I'm going to go back there for a second. So what they said about this graph is this tells us that the previously crazy hot market has turned into just a hot market, but it also tells us that if the cooling trend continues at a similar rate, we could be in a warm market within a month and a normal market within just 2 months. The former is very likely, the second is more speculative, and anyone who tells you they know what the market will be doing in 3 months is kidding themselves. So they're very specific in that it is so hard to predict, but if we keep going on this path, we're seeing some pretty significant changes in a short period of time. And then as we talk about the CMI here, another note from them, it will take several months of this trend continuing to reach a balanced market, but this no longer looks like such a far-fetched idea. So last week or the week before, they were saying, yes, we're headed towards balance, but it's going to take a long time to get there. And now they're saying it's still going to take a few months, but it doesn't look like it's too out of the realm of possibilities. So that's an interesting change. So thank you for coming to this update. I hope it was helpful. I want to hear from you if you have any questions about the market. And if you want to know what your contract ratio is in your city or your zip code, I can pull that information for you. So I have a link in the description below where you can click on that to request that information, and I will get that to you. And if you are looking to possibly sell your home before this market gets into more of a balanced market, check your instant home valuation. I have a link for that below. And if you're looking to buy and take advantage of not having to compete against so many other buyers out there, check the description below. I also have a link to search my MLS for homes in the Phoenix area. So I hope all of this was helpful. Comment your questions below or reach out to me if you have any questions, and I will be back next week with another market update on Monday. I'm Caitlin McKegg with the Desert Dreamers team at HomeSmart.